Welcome to week 6 lectures, week 6. And this is one of the important topics, like we looked at tax planning issues, which is also very important. Tax avoidance is also key to your advanced level syllabus. So this is where you're going to compute and advise for single companies and for groups, because this is where the related party issues are. Because tax avoidance is normally between related parties, okay? So this area is very crucial for the ICA syllabus. What is tax avoidance? Remember, we have mentioned 3 things that can minimize your tax liability: tax evasion, tax planning, and the third one we are coming to mention is tax avoidance. And you should be able to distinguish between the 3 of them, okay? Tax avoidance is a legitimate act of taking advantage of the gray areas or loopholes in the tax laws to minimize one's tax liabilities. Now, when you look at this definition or description, you will realize that just like tax planning, it is legitimate. Tax planning is also legitimate, and they all aim at minimizing one's tax liability. But the only thing regarding tax avoidance is that, unlike tax planning, where the provisions may be so clear in the tax law, which the taxpayer is taking advantage of, this one, the taxpayer is also taking advantage of the law, but he is taking advantage on the fact that the law is not explicit so far as the provision is concerned, and is using that inexplicable part of the law to minimize his tax liability. And when he does that, it is not illegal because the law has not explicitly said it should not be done. Have you seen where the gray area comes from? The thin line that I'm talking about comes from. Because they all take advantage of the law. And the law has been forbidding them not to do so. Okay? Now, tax planning is concerned with exploiting the detailed provisions of the tax laws and regulations to avoid paying or reduce the total amount of tax payable. You are exploiting the detailed provisions of the tax laws and regulations to avoid paying or reducing the total amount of tax payable. Therefore, tax avoidance is used to describe tax reductions achieved through artificial but permissible arrangements of personal or business affairs. Very key words I've used here. Tax avoidance is used to do what? To describe tax reductions that are normally achieved through what? Artificial, but what? Permissible arrangements of personal or business affairs. It is a legal activity. That's what I'm saying. When you explain tax plan, you have to say it's legal. It's the only one that when you have to, which is illegal, which you have to say is tax evasion. So tax planning, when you are explaining, always say that it is a legal activity. Hence, there is nothing illegal about tax avoidance. And this is captured in Judge Leonard Hand in the case of Commissioner versus Newman, 1947 Supra, in the following words. The fact that it is not an illegal activity is captured by a pronouncement of a learned judge called Judge Leonard Hand in the case of Commissioner versus what? Newman in 1947 Supra, in the following words. For example, Lord Tomley, yes, that is one. No, what the point we are making here is that the issue that it is not illegal was captured in a statement by a learned Judge Leonard Hand, in the case of Commissioner versus Newman. Okay, it is not in the following words. No, the words here have not been stated here, but another judge called Lord Tomlin, he is being quoted as saying to support the meaning of tax avoidance. So what I'm saying is that both judges are in support of it. Okay, and the case of Lord Tomlin is what is being quoted here. So Lord Tomlin is rather being quoted as saying that the subject is entitled to arrange his affairs so as not to attract taxes as far as he can legitimately do. I decided not to bring his hands on here because his quote is too long, but I want the one you can easily remember in the other room, and that is what the one for Lord Tomlin. And Lord Tomlin is quoted as saying that the subject is entitled, the subject can be the taxpayer, or it can even be the tax consultant, whoever, is entitled to arrange his affairs so as not to attract taxes as far as he can legitimately do. So when you explain tax avoidance and you hit it with this quotation by Lord Tomlin, it's a plus for you. It's a plus for you just to support the fact that there's nothing illegal about tax avoidance. Now, it's important to know how tax avoidance is achieved. Because one may ask, how do you achieve tax avoidance? So how tax avoidance is better achieved? Tax avoidance is quite juicy among associates or related parties or connected persons. Associates, related parties, or persons for whom there is a connection. That's how. So if you want to see how tax avoidance can be achieved, please, it is juicy among which people? Among associates or related what? Parties, or people that we refer to them as what? Connected persons. Then the second point you have to say, having different tax liability situations. When these related parties have different tax liability situations, they will want to engage in all forms of tax avoidance to shift tax from one lower tax bracket to a higher tax bracket for the overall advantage of the related parties involved. So when you talk about the fact that it is better achieved among related parties or connected persons or associates, you need to hammer the fact that if those associates have different tax liability situations, very important point. Don't just say it's achieved among related parties or connected persons and stop there. Say that having different tax liability situation. For example, let's say one party in the relationship is supposed to pay tax at 8%, another party in the relationship is supposed to pay tax at 25%. So these are related parties having what? Different tax liability situation. So they will engage in the tax avoidance practice by shifting higher profit to the party that has a lower tax rate, and only shift a lower profit to the party that has a higher tax rate, so that put together there will be a tax reduction for the benefit of the group. This is how you explain how tax avoidance is achieved. So in this, since connected persons will shift income from a higher tax bracket to a lower tax bracket so as to achieve an overall tax advantage among themselves. Now, when they say connected persons, Who are connected persons? This question came in the ICA 2009 term, and students were asked who connected persons are for 20 marks. The mark was just 2 marks because you need to write, it was just about a 1-page solution, and then you get 20 marks. Connected persons are persons with whom there is a connection. Connected persons are what? Persons with whom there is a connection. And they are also referred to as associates or related parties. And if you want to continue explaining, you have to point out the fact that persons can be connected at the individual level, they can be connected at the partnership level, they can also be connected at the company level. So you need to explain how persons can be connected at the individual level. For example, you can talk about an individual and a wife, they are connected. An individual and a wife's sister, they are connected. An individual and a brother, they are connected. And any person from that individual descent, they are all connected. They are related. Okay? At the partnership level, the partners themselves are connected. They are related. And the partners are also related with the partner's associates, the partner's wife. If I'm a partner, I may be connected to my fellow partner's wife. They are connected. At the company level, there can be a parent and a subsidiary. They are connected. And don't forget that sometimes the acquisition can come directly or through indirect acquisition. And all persons in the acquisition with the one who was acquired, they are all connected. So there can be a subsidiary. They are all connected. And even it is possible to have a percentage that do not influence, that have only, in other words, it's not a control relationship, but an associate relationship. That is acquisition below 50%. But they are all connected. Even if it's an ordinary investment, once there is a holding inside, you are connected. That's at company level. And in that sitting, in trying to explain, you must always say that the law, first of all, you have to say that the tendency that persons who are connected are likely to transact or transfer prices among themselves at non-arm's length is very important, and that can lead to substantial loss of revenue to the state. However, the tax authorities or the law requires that any transaction between connected persons or related parties must be done at what? Arm's length. You see this, you are getting it. Okay, let's move on. Now, anti-avoidance provisions. We have looked at what is tax avoidance. We've looked at how tax avoidance is better achieved. Now, what is the effect of tax avoidance? In fact, the overall effect is that government will lose a substantial loss. There will be a substantial loss of revenue to the state, whilst that will benefit those who are connected or related parties. So, since tax avoidance is not an illegal activity, which when related parties engage themselves in, they are not punishable under the law, government thought it wise to enact provisions in the tax law to counteract the tax avoidance practices. Thus, those provisions which are enacted in the tax laws to counteract the tax avoidance practices so as to eliminate the effect of the tax avoidance is what we refer to as what? The anti-avoidance provisions. To combat this, the revenue authorities need to keep close tabs on the performance and practices of taxpayers so as to immediately detect as well as find solutions to nip them in the bud. This has led to the enactment of what? Anti-avoidance provisions in the tax laws and regulations, either to handle specific cases of tax avoidance or general cases of what? tax avoidance. So the anti-avoidance provisions are enactments in the tax laws to counteract the adverse effect of tax avoidance. And these provisions in the tax laws, some of them are to handle specific cases of what? Tax avoidance practices. Whilst some may be to handle what? General cases of what? Tax avoidance. Take note of that. Let me explain it. So what are these anti-avoidance provisions? Because you see, before the Income Tax Act of 2015, we used to have the IRS Act. And even before the IRS Act, we used to have what we call the SMCD 5, 1975. In the SMCD 5, 1975, which ended in the year 2000, there were no anti-avoidance provisions in the law. So the taxpayers were, the related parties were engaging themselves in tax avoidance practices, and they were getting away with it. But in the IRS Act, which started from 2001, right down to the Income Tax Act, there are what? Anti-avoidance provisions in the law to nip these practices of tax avoidance in the bud. What are these anti-avoidance provisions in the law? The following are the tax avoidance practices and the anti-avoidance provisions. So when you take one of them, you need to look out for the tax avoidance practice there and what has been enacted to counteract it. Okay, very important to in each of them, you need to state what is a tax avoidance practice and what is in the law to counteract it. So the following are the tax avoidance practices and the anti-avoidance provisions. That's ways to counteract them as enshrined in the Income Tax Act of 2015 at 896. They are, number one, change in accounting year. And here, though when we are learning taxation, we normally don't worry ourselves learning the sections of the law that say so. For this one, I would say that if you can just chew the section in your head, it's not bad. Because sometimes they can refer to the particular section. And if you don't know that this particular section is talking about this particular tax avoidance and its anti-avoidance provision, you may not be able to answer it. Okay, so for this one there, I'll just beg of you. I'm not saying that you should by force learn the section here, but if you can, I will appeal to you that just put the section in your head if you can. For example, if you say change in accounting year, which section of the Income Tax Act of 2015 says or talk about the change in accounting year? And it's section 18. Okay, you can even deduce ways of learning it. I took it from 18, I arranged it like 18, 31, 32, 33, 34, 59. Before there was one B that has about 3 sections put together. That's a change in ownership. So if you look at change in accounting year, is section 18 of the Income Tax Act of 2015 at 89 cells. Arm's length standard and arrangement between associates, section 31. Income splitting, section 32. Fin capitalization or debt restructuring, section 33. General anti-avoidance rule, section 34. Taxation of shareholders, section 59. Change in ownership, this came last 2 sittings, section 38, subsection 2, section 47, and section 62 talks about change in ownership. So let's go again. What are the various tax avoidance practices in the Income Tax Act? In the Customs Act, they normally fall on the general anti-avoidance rule. Okay? We have the arm's length standard and arrangement between associates. Very important. Income splitting. Fin capitalization or debt restructuring, section 33. So the first one, change in accounting year, section 18. arm's length standard and arrangement between associates, section 31, income splitting, section 32, fin capitalization, section 33, fin capitalization or debt restructuring, section 33, the general anti-avoidance rule, section 34, and section 59, taxation of shareholders, section 38, subsection 2, section 47, and section 62 has to do with change in ownership. So we are going to look at them one by one. Okay. So we are going to start from change in accounting year. And that's the anti-avoidance provision is the section 18, subsection 3 and 4. But the change in accounting year is talk about section 18, subsection 1 and 2. You see, this is where the basic law came out from, section 18, where we were told that when it comes to individuals and partnerships, that individuals and partners in a partnership, okay, that commenced business from 2001, I told you that their base product has been defined by the law. It should end on 31st December by force. But when it comes to companies or trusts, as for them, they are allowed to use their own accounting year. So it means that if it comes to those who can manipulate, then it's going to be companies or trusts. Because the law says that as for them, they can use their own accounting year other than 31st December. So when it comes to change in accounting year, then the emphasis will be for companies and what? Trusts. Because since they are allowed to change their own, to use their own accounting year. Okay. So since a company or a trust is allowed to use its own accounting year, then in a bid to avoid tax so as to minimize their tax liability, if they find out that pronouncements have changed leading to lower tax rates for certain periods, okay, they can quickly change the accounting year to coincide with the period, so that even if they have made large incomes, okay, they will pay lesser tax. They will pay lesser tax because of the fact that they can change their accounting year to suit the pronouncement that is bringing about a lesser tax. That's the tax avoidance practice there. The ability of companies or trusts to change their accounting year to coincide with a provision or enactment that is likely to make them pay a lesser tax. That tendency is there because of the fact that they are allowed to use their own accounting year. Now, what is the anti-avoidance provision in this section? The anti-avoidance provision is that before you can change your accounting year, you must apply to the Commissioner General that you want to change, and you must give reasons why you want to change the accounting year, and the reasons must be justifiable. And the reasons, and that when the reason is justifiable, before the Commissioner General will approve the application. But even if the application is approved, Commissioner General will set some conditions, and when you break those conditions, then they will revoke your approval. You see, so that is the anti-avoidance provision in the law. Something that cannot make it smooth for you. You understand? Number one, when it comes to the anti-avoidance provisions regarding change in accounting year, the fact that number one, you need to apply to the Commissioner General for approval to change. The application normally must be in writing, okay, and must give reasons why you want to change the accounting year. And it's not just giving the reason, but making sure the reason is justifiable, okay. And even if it has been approved, Commissioner General will set conditions regarding the approval. And the fact that when those conditions are broken, the approval can be revoked. Those are the anti-avoidance provisions in subsection 3 and 4 of section 18. And that's all about the change in accounting year. So let's go and see some of the. Now, who are the entities qualified to apply for the change? I told you that they are trusts and companies, isn't it? Okay. What conditions for approval? I told that even when they will set conditions for approval. Okay. So what are the conditions for approval of the change of the accounting year? And the condition is to make sure that there are no revenue, the change will not bring about any revenue leakage or any revenue gap or any coinciding periods. You see, when you are changing when you are changing your basis period, the fact that the old basis period may sometimes coincide, may overlap with the new basis period is there, or the fact that the old basis period, there could be a gap between the old basis period and the new basis period, which will mean that you will not pay tax within the gap period, is also there. So they will bring you a condition which will avoid an overlapping period and which will also avoid a gap. And that's the condition you will see as we are coming to discuss now. So condition for approval of the change of accounting year. The trust and company must first apply to the Commissioner General in writing for approval prior to the change in accounting year. The trust or company must specify in the application indicated in here above how it intends. How do you intend to deal with the transitional period that is between the old accounting year and the new accounting year? How do you intend dealing with it? To ensure that there is no gap or revenue loss. And B, what is the reason for the required change in accounting year? Okay. Now, number 3, the trust or the company should have filed all relevant returns to the old up to the old accounting date and also the new accounting date. This to avoid any revenue gap. So even they will require of you to make sure you have filed all relevant returns up to the old accounting date and even up to the new accounting date that you want to start. So if you are somebody who doesn't like filing returns, you will not even bother yourself to say that you want to change your accounting year. Now the trust or company, number 4, must have settled all taxes. Look at the conditions. Charlie, no be small. The trust or company must have settled all taxes, interest or penalties due. Or if you don't have the money, you must have made satisfactory arrangement with the Commissioner General to settle the outstanding debts, if any. And the arrangement must not be broken. And then number 5, all directors of the trust or company should have filed and paid all relevant taxes. The question is, can you satisfy this? If you think you cannot satisfy conditions for the approval, you don't even dare. Now, the implication for change of accounting year. When there is a change in accounting period, it's important to note that 3 relevant years are to be considered. So please, if you are learning this topic, then we are looking at the implication of the change of accounting year so far as the three relevant years are concerned. The first is that you have to consider the 12-month period up to the end of the previous accounting year. So if you are changing from in year 2019, then you need to consider 12 months period up to the beginning of 2019. That's the first year, you must consider that one. Then the second year, it should be a second period beginning from the date after the end of the previous period to the end of the new period, so that it not create any overlap or any gap. 3, and the last one, the next year, being the third year, it should be the next year of assessment following the year of change, in which the company has a full basis period which is not overlapping or is without a gap. Now we're going to look at that in an illustration shortly, what I've just said. Now we are going to look at that assessment procedure on the change of accounting year. where whenever a request for a change of accounting date has been approved, the trust or company making the change shall be assessed to tax through special process of determining the basis of assessment. This process requires computation of 3 relevant years, and these are the years I was talking about. Okay, the Commissioner General will adopt the following procedure to determine the assessment for the 3 relevant years. Number one, identify the 12 months period up to the end of the previous accounting year. Identify the second period beginning from the date after the end of the previous period to the end of the new period. Any calculation should be mindful of overlaps or what? Gaps. Then when you are doing it and you are getting overlaps and gaps, then you are not doing it well. And then about the third year, identify the next year of assessment following the year of change, in which the company has a full basis period which is not overlapping or is without a gap. Okay, so we'll look at that soon, like I told you. Now, reason for the change in accounting year, or maybe let's project it, and then we'll come back to the reason. You see, sometimes the reason can be genuine. Okay, it is not in all instances that a company or a trust will always want to avoid tax. That is why they want to change. No, in some cases the reasons could be so genuine, but even when the reasons are genuine, make sure these 3 relevant years, the provision in the law is satisfied. Now, this is what the 3 relevant years we are talking about. We are using this example to explain that for you. It's very simple. Now, where a company or trust prepares accounts for a short period ending in the year of change. Now, XYZ company prepares accounts to 31st December each year. Okay, so formally, they were preparing accounts when 31st December. But in January 2016, the company applied to the Commissioner General to change the accounting date now to September. Perhaps they've heard that come September of that year, before the September of that year, or come September of that year, the rate will come down. So they want to quickly change from January to December so that by 30th September, they will take advantage of the lower rate. Okay. The company presents 3 accounts stated below. Year 2. Anytime they say year 2 means from the beginning, 12 months to that date. That's the meaning of year 2. Year means 12 months, isn't it? So please, anytime you see the word year 2, it is what? 12 months to that date. So, for example, year 2, 31st December 2015 means January, it means the year of assessment will be 2015, and the basis period will be from 1st January 2015 to 31st December 2015. Okay, and that will be 200,000. Period 2. Period 2 there, it can be any period. Period 2 is not the basis period, no, it can be any period. Okay, but in this case, because the previous year was 31/12/15, and the period 2 can be from 1st January 2016 to 30th September 2016. Because the period 2, it should be to 30th September. So you are beginning from the year following to September, and that will be for 9 months. Year 2 again means 12 months, isn't it? So if it is year 2, 30th September 2017, 12 months to 30th September 2017 will be 1st October 2016 to September 2017, and that will be 12 months because of the word year 2. They will make a profit of what? 450,000. Now they say determine the chargeable income for the relevant years. So remember that this is a company that wants to change its accounting year, and with the law says that when it comes to the change in accounting year, 3 relevant years are very important, and it should be written the way the law says so. So if you look at year 1, okay, they want to do the change in what? 1st January 2016, and the law says that then you must write a period up to the end of your previous accounting year before the year of change. Now your previous accounting year is what? 31st December. So they say you should write 12 months up to the end of the previous accounting year. So In 2015, if they were preparing accounts to December, the accounting year would have been from 1st January 2015 to 31st December 2015. Okay, and that would be equal to the figure to the year 2 over here. Okay, and that they said they will make a chargeable income of what? 200,000. So that one you don't do any apportionment. Now, if you look at the law says that the second year should be from the beginning of the previous accounting year to the end of the new year up to the date that you want to make the change. Okay, so if you look at it 2016, because from 2015 the next year should be 2016, so it's going to be where from the beginning of that accounting year, the year of change, to the end of your accounting date that you want to use now. Okay, that's what the second year will be, and that will be for only 9 months. But when you look at the period 2 year, remember this one is here, you must define it and connect it to how the law wants you to write it. And I'm saying that if I'm defining year 2 means January to 12 months to that date. So if I have a year to 31st December 2015, then it will be January to December, and it is the same as the one here. So I don't do any apportionment, I copy the figure. Then the law is saying that for the second year, it should be from the beginning of the year of change to the end of the date that you want to now use. And that is what is here. And if you look at the period 2 that they have stated here, then it will be from January to September, and that one too, it will coincide. So I'll just copy this figure and put here, I will not apportion. Then they say the third year will be, now that you have changed to a new accounting year, it will be from the beginning of the year that you want to now do your change, 12 months to the end of that year. So it will be from 1st October 2016 to 30th September 2017. Remember, baseball must end in a particular year of assessment. Okay, so again, that's the definition of the year 2, which has coincided with this one. Therefore, the 452 I'll copy and put there. So this is how you'll be writing it by way of solution. Okay, that's all. Now let's go to another illustration and see example 2. Now this example, they say where a company or trust prepares accounts for a full year ending on its new accounting date. The first one, they're preparing it not for a full year ending but for a short period ending the year. That's why we didn't apportion anything. But look at this one. They say the company or trust prepares accounts for now a full year which ends on its new accounting date. So for example, SYZ company prepares accounts to 31st December each year. In January 2016, the company applied to the Commissioner General to change its accounting date to September, just like the other one. The company prepared 3 accounts as follows. Now, in the year of change, they say they will prepare it for the whole year. But before then, they were preparing to December, isn't it? So the first year was year 2, 31st December 2015. But this one, they wanted to prepare for the whole year, which will end on their new accounting date. So that one, it will be from 1st October to what? To 1st October 2015 to 30th September 2016. And if they do that, there will be an overlapping period because 31st December 2015 is here already. So if you go and start from 1st October 2015 to 30th September 2016, you'll be having October, November, December, which already is in 2015, which already is in this year. You will also be having the same period here. So there will be an overlap. Okay, but the law will want to provide something like this. So that's why they have given you how you should write it based on the law, but not based on the way you are preparing your accounts. Okay. Then a year 2 will also be 12 months to this date. Now determine the chargeable income for the relevant years. Now you write this only if the question says they want to change the accounting year. Now, so the law says that in the first year, write it 12 months up to the end of your previous accounting year. So if I'm following the law, my previous accounting year would have been what? 2015, because it was in January 2016 that they want to do the change. Okay, so your previous accounting year will be 2015, and they say write 12 months up to the end of that previous accounting year, and that will be from 1st January 2015 to 31st December 2015. Okay, then the second year they say write it from the beginning of the new year, okay, up to the end of your accounting date for the new year, and that will be from January 2016 to 30th September, and that will be 9 months. So that they want to avoid that overlapping period, okay? And then for the third year, you now continue writing from the beginning of your new accounting year to the end of your new accounting year, and that will be from 1st October to 2016 to this. So because of that, for this one, the 2015 one, it will coincide with the year 2. So I'll just copy the figure and put it there. But when I come to 2016, you will see that here it is 12 months because of the year 2. But this one that you have written here is only 9 months. Therefore, you divide 9 over 12 times the 300,000, and they will only assess you on 225,000. Then in the 2017, the year 2 will coincide with this very one. So their base one will coincide. So that one you only copy the figure and put there. That's all. This is how we write it. Okay? Take note of that. So let me now go to some genuine reasons why a business may want to change its accounting year. Some genuine reasons why a business wants to change its accounting year. Reasons for change in accounting year. Okay. Number 1, there are a number of reasons why an entity may want to change its accounting year. Not necessarily because they want to avoid tax. The reasons may include, number 1, the need to synchronize. The need to synchronize the accounting date of a subsidiary with that of a holding what? Company. You see, maybe there is a parent and a subsidiary company, and the parent prepares account to December, subsidiary prepares account to September. So one of the reasons why one of the entities want to change is that they want to make sure the two accounting dates what? Harmonizes. Okay, and that's a genuine reason. Number 2, sometimes for the convenience of what? Stock taking at a particular period of what? The year. Maybe they are taking stock in December is not comfortable for them, and it will be better if they shift it to September. So that's why they may want to change their accounting year. Number 3, a business may take over the operation of another, and as a result may need to change its accounting date of the company taken over to that of its own. So whenever there is an what we call acquisition, mergers and acquisition, it can also prompt the change of an accounting date. Okay, a predator and a victim. Okay, when the company, the acquirer can want to maybe also make sure the two, both the accounting date of the acquirer and then the acquirer, they come together. A business may take over another. Okay, maybe I was preparing account in September and I'm taking over a business that prepare account in December. So what do? I have to change the accounting date to coincide with mine, and it can be a genuine reason. Number 4, sometimes to conform to a regulatory provision. So this one, if there is a regulatory provision requiring you to change, who are you to say you will not change? You see, so sometimes there can be genuine reasons why a company want to change, but whether it is genuine or not, as for the procedure to follow, it will not change. Thank you. That's all for change in accounting year. Okay. Now the next, tax avoidance practice and the anti-avoidance provision in the law is income splitting. Now you could see that I've jumped over section 31, which talks about the arm's length standard and arrangement between associates. I've jumped over that because it's a long topic. So I'll shift to that after we have talked about all the rest of the tax avoidance practices, and then we'll devote our time to talking about the arm's length principle and arrangement between associates, and the same as transfer pricing. Okay, so we'll devote the time for that one. That's good. Please, this area, learn them well. Okay, So the second one I would like to discuss is the income splitting, which is in section 32. Okay. Now, when you look at this, the tax avoidance scheme here is that where, based on the fact that there can be a different tax liability situation for related parties, in that if you should split the income among related parties and the income is being taxed at a lower rate in the hands of one party and at a lower rate also in the hands of another party, because you have split the income among themselves, then instead of putting the income together, aggregating the income, which will make you fall in a higher marginal tax bracket, then the tax sabo person will want to avoid the tax by rather splitting the income among associates, so that while the income is divided and the amount becomes smaller in the hands of the associates, each person therefore will not fall into higher marginal bracket and will therefore pay a lesser tax. That's the idea. That's why we normally don't split income for tax purposes. Incomes are supposed to be aggregated. That's anti-avoidance. It must be aggregated. We don't split it, because, and this happens especially when it is a progressive system of taxation, where by splitting the income, you pay as you earn. So the lesser you earn, the lesser you pay. The more you earn, the more you pay. By aggregating the income, it will be the more you earn, because you will fall into higher marginal tax bracket. So the more you pay. But by splitting it, the lesser you pay. That is for example, a sole proprietor. Then if you want to take the case of a company, you can have a company where they decide that majority of their income, a company that, for example, sells some of its products at home and exports some, knowing very well that exports are taxed at 8%, which is a lower rate, and then the income and the corporate income tax for the domestic income is, say, 25%. Oh, then what the company will do, okay, is to set up a subsidiary that perhaps goes into exports, and the subsidiary can be feeding, so the parent company can be feeding the subsidiary with materials which will be using, and he can do that at very high prices, so at very low prices, so that the parent will have a lesser profit, while the subsidiary will be buying at what? At higher prices. The parent will be giving to the subsidiary at lower prices, so that the revenue of the parent will be so small, whilst the purchases or the purchase cost for the subsidiary will be very low, and for that matter, the profit will be very high. Meanwhile, he pays only 8% as tax because he exports, and this guy too, because he pays tax at 25%, and his income is low because he's supplying the item to the subsidiary at a lower price, the 25% will be slapped on a very lower profit, so that in effect the group will benefit. So you can explain it also in terms of a company by using this particular illustration, as far as splitting the income is concerned. So for instance, a parent whose income attracts tax at a current top tax rate of, let's say, 25%, transfer part of the income to a spouse or a child with a marginal rate of, say, 17.5%. And even this one now, the current top bracket is now 30%. It's no longer 25%. I'm talking about a graduated rate. You know, in 2020, they have changed it to the current top bracket is what? 30%. Where you are aware. Okay, so we can even change it for 2020. Because most of your questions are 2019, that's why we maintain this one. Otherwise, we have used 30%. Okay. Okay. So knowing that, you will transfer part of the income to a spouse or a child with a marginal rate of say 17.5%. That if it with the income will fall there. So that is for individuals who are being taxed at graduated rates. Now another example can be for a company where a parent company which pays tax at 25% transfers income to an exporting company which is its subsidiary that pays tax at what? 8%. See, so once they are splitting the income among themselves like that, the overall effect is that they will pay a lesser tax. So this is the tax avoidance practice and the income splitting. Okay, now what is the anti-avoidance? We'll come to that. So therefore, a reference to a person attempting to split income includes a reference to an arrangement. So this is where they're doing the arrangement between the associated persons for the transfer of an asset directly or indirectly. That is, this is the way by which they can go about if they want to split the income. They can do so through the transfer of an asset directly or indirectly, including the transfer of an amount derived. 2. Where the transferor retains legal or implicit right to benefit from the asset currently or in the future. And where one of the reasons for the transfer is to lower the tax payable by an associated person. Now, so this illustration here can buttress this point. Now, Uncle Willie's chargeable income for 2016 is 1 million. To avoid tax, Uncle Willie decided to transfer his income to associates as follows. You see, this is a one-man business. So he would have earned 1 million, but because of that, he has employed a wife. Maybe the wife is the deputy MD. He will give a title. The daughter is a receptionist. The son is a driver. Okay, and they are on payroll, and then he himself 350. So when you look at this income, when you put it together, it's the same 1 million here. But what has he done? He has split the 1 million among the associates. That is the wife, the daughter, the son, and then himself. Now required, determine the tax that would have been avoided by Uncle Willie, but for Section 32 of the Income Tax Act of 2015. So now, if you don't know what is in Section 32, how will you know that this is talking about income splitting? Because I told that Section 18 is changing accounting year. Section 31 is arm's length standard and arrangement between associates. Section 32 is income splitting. Section 33 is with fin capitalization or debt restructuring. Section 34 is the general anti-avoidance rule, etc., etc., etc. So I'm saying that if they say but for Section 32 and you have not learned that Section 32 deals with income splitting, you will be applying another tax avoidance rule to check this one, and you will be wrong. That's why I said that for this particular one, at least try and know the sections that has to do with the tax avoidance practices. Okay, so that is that. Okay, so let's look at it then. Now, when this happens, remember the guy has transferred the income to the various associates. Okay, because of the fact that there is an anti-avoidance provisions in the law, Commissioner General will invoke Section 32 so that he will recharacterize the income to where it's supposed to be. So the first step is to compute the tax paid by each associate using the 2016 tax scale. So in this question, for example, they will give you the tax scale for that year, and then you use the scale to compute tax on 250, 200, 200 again, 350, okay, using the graduated rate. So students must know how to use graduated rate to compute tax on the chargeable income when it's a pay as you earn. We'll be learning that when we are doing employment income, okay? So when you use the scale, these are the various taxes that each of them will be paying, okay? Meanwhile, you'll be surprised that the wife even doesn't step there, doesn't even come to the place, but it's also is the deputy MD. Okay, so total tax that Commissioner General will get if they engage in income splitting will be 235,330. Okay. Now, if Commissioner General invokes Section 32, which allows him to recharacterize the source of the income by aggregating it for tax purposes, then what Commissioner General will do is that he will therefore be allowed to he will tell Uncle Wood by adding back. You see, they will start with profit per accounts. The self means this is a profit for the business. Remember, it's a one-man business. So profit per accounts would have been 350,000. Then they are going to add back those tax avoidance schemes that reduce the profit. They will add back. So they will add back 250, 200, 200 again to the 350, and the whole thing become 1 million. Then the tax now will be computed on 1 million using the same graduated rate, and that will give you 246,335.50. Now the tax that would have been avoided, but for Section 32 will be the difference, okay, between the tax on the aggregate amount of 1 million and the summation of the taxes on the various incomes that were split, and that gave a difference of 11,002.50. So this would be the tax that would have been avoided if Section 32 was not there. That is all. Okay, so that's that for income splitting. Then the next one we go to is fin capitalization or debt what? Restructuring. Fin capitalization or debt restructuring. And this one is very, very interesting. Very, very, very interesting. This has to do with the capital structure of a company. You see, when there is a subsidiary and a parent relationship, or when it's a related party relationship, they can also avoid tax by using their capital structure. So what this one is trying to say is that, and note, if you are learning this topic, it is between two related parties or associated persons. The first person is called an exempt person. Then the second person is called an exempt resident, an exempt controlled resident entity. Please, when you are discussing fin capitalization or debt restructuring, which is in Section 33 of the Act, this particular tax avoidance scheme is normally enacted between an exempt person and an exempt controlled resident entity. Because these are the two things we are trying to look at. Okay, an exempt person and an exempt controlled resident what? Entity. Okay, and the law says that, okay, let's look at who they are, and then now we come and apply what they do. Let's go and look at them. So you see, obviously, I'm going to take you through the meaning of what? An exempt person, also sometimes called an exempt controller. Okay, an exempt person, also sometimes called an exempt controller. When the IRS Act used to call them all exempt controller, but the income tax had just said exempt person. Okay. Then we'll come and learn who is an exempt controlled resident what? Entity. You see, an exempt controlled what? Resident entity. Okay. Now, an exempt controlled resident entity is a resident entity controlled by an exempt person. Wow, you finish. You see, who is, I thought that this particular tax avoidance scheme that is feigned capitalization or debt restructuring is between some two related parties. One is called an exempt person. The second is also called an exempt controlled resident what? Entity. And I'm saying that what's the meaning of an exempt controlled resident entity? An exempt controlled resident entity is a resident entity, an entity that is in Ghana or established under the laws of Ghana, or whose management and control is being exercised at any time in Ghana here. Okay, it's an exempt controlled. Look at the word. He is being controlled, so it's an exempt controlled resident entity. Is a resident entity controlled by an exempt person. That's all. Now, who is an exempt person? An exempt person, but see, let me also point something here. When they say an exempt controlled resident entity, is a resident entity controlled. What's the meaning of the controlled that they are talking about? It means a resident entity, it means that the exempt person has 50% or more holdings in that resident entity. That's why they are calling that resident entity an exempt controlled. It means that that exempt person has what? 50% or more voting power in that what? In that resident entity. That's why it's called an exempt controlled resident entity. And it's a resident entity controlled by an exempt person. It is called exempt controlled because that exempt person has 50% or more holdings in that particular entity. I hope it's coming out well. That's fine. So now we know who is an exempt person, an exempt controlled resident entity. And you know why they are using the word controlled? Because that exempt person has 50% or more voting power in that entity. Okay, so it's like a parent-subsidiary relationship, sort of. That's it. Okay, now let's go and look for who is this exempt person at all that they are talking about. Exempt person, who is it? Because before you can answer the question, you must, especially when it's a calculation question, you should be able to establish, hey, this person is an exempt person. This person too is an exempt control resident entity. Before you can apply the principle of what? Tax fin capitalization or tax debt restructuring. Okay, you must first establish that the people that you have established those two related parties before you can say you are applying the principle of fin capitalization, because it only applies to an exempt person and an exempt controlled resident entity. So if you don't know the meaning, it is difficult for you to identify that, hey, this person is an exempt person, this person is also an exempt controlled resident entity. Now let's look at who is an exempt person. The law says that an exempt person is a non-resident person. Bah, bah. And then the B will be or, which means either this or that. Okay? It's not and, no. Or, it should be or it will be the B. Now let me take the first one. They say an exempt person is who? Is a non-resident person. Okay? Which means that what they are trying to say is that if there is a resident entity in Ghana and you have a non-resident person that has 50% or more voting power in that resident entity, then that resident entity becomes an exempt controlled resident entity. Why? Because that resident entity is being controlled by an exempt person. And how did I know that it's being controlled by an exempt person? It is because the person that has control in that company is a non-resident person. So the moment you are given a question and you have a non-resident person who has 50% or more voting power in a resident entity, then you have established that two relationship. There will be an exempt person, and then there will also be an exempt controlled resident entity. If the exempt person has less than 50%, please, fee capitalization does not apply there. You must have 50% or more voting power. Okay. So that's the meaning of an exempt person. That's one meaning. It can also mean, this time round, a resident person. For a non-resident person, they didn't say anything in addition. They say once you are a non-resident person, you are an exempt person. So all non-resident persons are who? Are exempt persons. But when it comes to resident person, for you to become an exempt person, they will add something. A resident person for whom interest is paid by a resident entity to an exempt person, or for whom a foreign exchange gain realized with respect to a debt claim against the resident entity constitutes exempt income, or is not included in ascertaining the exempt accessible income to that person. Now let me explain to you to make the work simple. All what they are saying is that when it comes to an exempt person and the person is a resident person, for that resident person to be called an exempt person, what it means is that if that resident person has a stake in the company and they have given, for example, a debt to that resident entity, and for that matter, if you have given a loan to your resident entity, loan attracts interest, so they will pay you interest. But if that interest is exempt from tax, then you become an exempt person. Or if you are not supposed to add your income, the interest to your income and tax, that income is not supposed to be taxed, the interest is not supposed to be taxed. It's because the interest is not supposed to be taxed. That is why you are now being called an exempt person. Now, if a foreign loan is involved, you are aware that until the resident entity settles the debt, if the cedi depreciates, there will be a foreign exchange loss to the resident entity, but a foreign exchange gain to that resident person. You see, when I should give a foreign loan to my subsidiary and I'm a resident person, okay, remember, if the cedi depreciates, once they have not settled the loan, if they are now coming to pay me the loan, I'll be getting a foreign exchange gain because they will have to pay me more cedis for the same amount of loan in foreign currency that I gave them. So two things are things that the resident person can gain from somebody that is controlling in Ghana. The person can gain interest on the loan, and then in addition, if that loan is a foreign loan, the person can make a foreign exchange gain, since more cedis will still have to be given for the same amount of loan. So these are two things that comes to that resident person, either the interest on the loan and or the foreign exchange gain. Okay, but the point is that both incomes, that is the interest on the loan and the foreign exchange gain, they said constitutes what? An exempt income. It's not tax, it's exempt. Or the one who receives it is not supposed to add it to his accessible income and tax. Because it is not taxed, that is why they are calling you the resident person as well, an exempt person. I hope I've driven home the point now. Okay. So now that we know the meaning of these two people, let's now go and see how they want to take advantage of this and want to outwit the tax people. Now, when it comes to the issue of fin capitalization, I said it is about the debt structure of the company. So remember that the person has an equity stake in that company, and that equity stake is 50% or more. That's what we said, we established in the first place. So whether it's a non-resident person or it's a resident person who has an equity stake in that resident entity, and it is 50% or more. So they have an equity stake already. Now, when the resident entity wants more loan, wants more capital, perhaps to expand, for expansion, or for any other reason, they may still call upon their parent, the parent company, to give them more capital. So they look at it and sort of, if you can be requesting capital from me, and I can give it to you in terms of equity or in terms of debt, because we are related, anytime you request capital from me, I will prefer to give you more capital in terms of debt rather in terms of equity. Remember, I have an equity stake already. But the point I'm making is that in terms of the debt structure that I have in that the capital structure that I have in the resident entity, I'll prefer that the debt will be far, far more than the equity. Why? Because debt is tax attract interest. Because debt attracts interest, and interest is tax deductible. Equity attracts dividend, but dividend is not tax deductible. So they will prefer to give more debt rather than to equity. And when that happens, we say the capital structure has been broadly capitalized. It has not been thinly capitalized. It has been what? Broadly capitalized. And when it is broadly capitalized, this is a tax benefit they are going to get. You will see that the resident entity will be paying interest to the exempt person, isn't it? Huge interest. And because interest is tax deductible, the resident entity will charge huge interest expense in the accounts. And the profit for the resident entity will therefore come down, and you will pay a lesser tax. Meanwhile, this interest that has gone to this exempt person is exempt from tax, or the person is outside Ghana. So it means that the tax authority will be losing on the interest income that the person is receiving. Meanwhile, this person who is paying the interest to that person, is charging huge interest in the accounts, and therefore expenses will be high, profit will be low, and the parameter will pay a lesser tax. And when that happens, it's a group that benefits at the expense of government. So they thought it wise. So that's a tax avoidance scheme. I told you, you must always know the scheme and then how to counteract it. Now, how do we counteract it? They therefore enacted in the law, section 33, an anti-avoidance provision by putting a cap on the debt equity structure of 3:1. That's debt to the equity. They put a cap on it, 3:1, which means that the cap is that any exempt person that has an equity stake in the resident entity, if the exempt person is giving capital to the resident entity in form of debt, the debt should not be more than 3 times the amount of the equity capital. That's all they are trying to say. If the debt is up to 3 times of the equity capital, any related interest that the resident entity is charging in the accounts will be allowed. Any foreign currency exchange loss realized, still on the principle of foreign currency exchange loss, we have explained that before, will also be allowed. Please, it should be realized. We don't realize one day, we don't allow it. It will be allowed. Does if the debt to equity is more than 3 times the amount of equity, then it means that the excess interest beyond the 3 times the amount of equity, or the excess foreign exchange currency loss realized beyond the 3 times the amount of equity, will be disallowed by adding back, because it is beyond the cap. That's all for this. So we're going to use illustration. Very, very interesting. And I wish when you get a question, you should always massacre it. Okay. So let's go and use an illustration to buttress what I've just said. Okay. This for example, I think this one came as a past question, November 2016. Below is a capital structure of Nyamiche Ghana Limited for the 2016 year of what? Assessment. So we have equity 20 million, loans 80 million, total 100 million. The loans were taken for Nyamiche Limited from the parent company based in Nigeria. Have you seen the thing? The loan, you see, the capital, it means that Nyamiche is the resident entity. And the parent company, it means that there's a controlling relationship. That's why they are using the word parents. So once they mention parent, that means the control is 50% or more. Okay. But this parent company is based in where? Nigeria. So it's a what? A non-resident person. So it means that the parent company is a non-resident person. And once the parent company is a non-resident person, then it's an exempt person. Because by definition, an exempt person is a non-resident person, or it can also be a resident person for whom the interest received and the foreign exchange gain realized is exempt from tax. So in this case, the parent is not a resident entity. If it's a resident entity, then we should be able to establish that the interest that you get or the foreign exchange loss realized will not be taxed before you can say it's an exempt person. But for non-resident person, then you don't even look at whether the interest is exempt from tax or not. Once you are a non-resident person and you have 50% or more interest in a resident entity here, you become an exempt person. So in this particular as a past question, Nyamiche will therefore be called an exempt controlled resident entity. It means Nyamiche is a resident entity, all right, but it's an exempt controlled resident entity. Why? Because he is being controlled by an exempt person. That's the point we are trying to make. So the moment you are able to establish this, they say, hey, then I should be thinking of the fin capitalization rule. That is the debt to the equity structure of the company in terms of these two persons. It doesn't mean that Nyamiche cannot go and take loan and equity from elsewhere. No, they can also take loans and equity from elsewhere. But when it comes to the one that relates to the exempt person and then the exempt control resident entity, this is the principle you must use. Because when you go and take equity from elsewhere who are independent persons, that one is not between associates or related parties. So there's no need for you to worry yourself because the transaction would have been done at arm's length. But the tendency that these people, because they are related and any tax avoidance scheme they embark upon will be to the benefit of the related or the group. That is why they enact anti-avoidance provisions in the law to counter the effect of the tax avoidance. Okay, so we go. So now we are going to establish that whether it is beyond the cap. Now look at this. The parent company in Nigeria has 20 million equity, whilst the loan, please, if the loan is given by independent people, don't consider the independent one, consider only the related party one. Okay, but in this question, all the loan came from the exempt person, so it's 80 million. So because of that, now let's look at the debt equity ratio. 80 to 20 is 4:1. 4:1. But the cap is what? 3:1. So the law says that when it comes to the debt equity ratio, the interest that Nyamiche can charge in the accounts, or any foreign currency exchange loss realized that Nyamiche can charge in the accounts, should only be up to 3 times the amount of the equity. Any excess will be disallowed. So in this particular question, you were asked to determine how the above transaction will be treated for tax purposes. So you look at 4:1. You first put down the structure, the current existing structure, and then you also go and do the cap one. Now, what it means is that if it is 4:1 and the interest that Nyamiche is supposed to pay is 700,000, the question is, should all the 700,000 be allowed? No. We will only allow its relation in terms of 3 times the amount of the equity. So it means that what you can easily do is that you say, if 4 is to the 700,000, I'm talking about the interest allowed. Calculation of, we are going to calculate interest to be allowed and interest to be what? Disallowed. Okay? So to determine the portion of the interest which will be allowed, you have to equate this whole of the 700,000 to 4, because the ratio will be 4:1. So the related interest is 4. Therefore 3, because 3 is the maximum that can be allowed, and that will give you about 5,000 or so. Then the difference will be disallowed. Or you can say, if 4 is to 700,000, the excess will be 1, because if 4:1 and the cap is 3:1, the excess is 1. If, for example, the current cap is 8:1, then the excess will be 5, because 8 minus 3 is 5. You understand? That will give you the disallowed portion. So very simple. So in this case, for example, I will say if 700,000 is equal to, if 700,000 is equal to 4, therefore 1, then that one I'll calculate the disallowable portion. Somebody can also say, if a loan of 80 million is attracting an interest of 700,000, how much is 3 times the amount of the equity? 3 times is 60 million, because 3 times 20 million, it means that the maximum debt that the parent company should have given Nyamiche, for which the interest will be allowed in the books of Nyamiche, is that it should be 3 times the amount of the equity, and that will be 60 million. Therefore 60 million, and then you calculate it will be, let's say, plus more divide, then you get a portion which will be allowed, you get the same figure. Then you can say that, oh, then if 60 million is the cap, then the excess of 20 million will be disallowed. So if the whole loan of 80 million is attracting an interest of 700,000, therefore the excess of the 20 million will be disallowed. And when you calculate it, you get it. And the same thing you use to apply for the foreign exchange loss realized. Look at this. They said, and also incurred an exchange loss of what? 500,000 on the repayment. Repayment means that the loan has been paid now, and once the loan has been paid, the foreign exchange loss has been what? Realized. Please be very careful. Unrealized exchange loss are not allowed. Now I have to wait until it is realized. So the questions, they don't say them kekero. If you don't understand it, the words there are very, they all have their meaning. So it means that it's a foreign exchange loss realized. But the question is, can we allow all the 500? We say no. We can only allow up to 3 times the amount of related equity. So if this figure 500,000 is to 4, therefore 3, then you get the amount allowed. Then you also calculate the amount is allowed. That's the excess. The excess is 1. So if 500,000 is to 4, therefore 1, then you calculate the amount disallowed. And when you do this, you get 6 marks. The avoidance is, so first of all, you explain the principle, and then you connect it to the question by calculating the allowed and disallowed. Those who first came out with the principle, okay, they said determine how. You understand? So you talk about this small before you start the calculation. That it should not be more than 3 times the amount of equity. Then you get 1 mark. Then when you do the calculation, they gave 2.5 for both the interest and then for both the allowable and the disallowed portion, and you had 5 marks, making it 6. So this question came for 6 marks, and to me it's a bonus question. I'm telling you, it's a bonus question. Okay, so that's where this is a solution that we are projected. Some people can also calculate the rate of interest and use it. You see, because some questions, instead of giving you the amount of interest, they can also give you the rate. How do you get the rate? This is the loan amount divided by the total debt. The rate is 0.875%. Okay. So all you are doing is that the amount on the loan, you can apply the rate on it. The allowed portion will be 60 million. So interest of 0.875% on 60 million will give you the allowable portion. Then the disallowable portion will be the interest on the excess of 20 million. The rate will give you the one side, also the same thing. Or you can just do simple proportion. If this is to this, therefore this. If 4 is to this, therefore 3, therefore 1. That one you get the same thing. I'll go for the simple proportion one. I don't want myself to go and calculate interest rate. If I go and do interest rate and it's wrong, I'll have a problem. Okay, unless in the question they give me the interest rate, then I use the interest rate given to me in the question. If they don't be given to me, I can just use numbers to determine the allowable portion and then the disallowable portion for tax purposes. Okay, so that's all. But let me say this: the fin capitalization does not apply to financial institutions, because for financial institutions, any loan that they are receiving is what they're dealing. The lending is what they do. Okay, so if parent companies are giving them loan for them to on lend, okay, don't forget, if the person is charging you a higher interest or a lower interest, whatever it is, you can also not on lend it at that very high anyhow, because people may not partake in it. So that fin capitalization does not apply to resident financial institution. I repeat. So when you are writing, say if a company which is not a financial institution, that's how we normally write it. A company which is not a financial institution, a company which is not a financial institution, because it does not apply to financial institutions. Because what I'm saying is that if even it's a financial institution and they want to outwit the people through tax avoidance scheme by pushing more debt to the bank than equity and charging high interest to the bank so that the bank can pay them higher interest so that we'll charge it in accounts and all that. Forget that. For the loan is not their capital, it's a stock in trade, it's a deposit they have received which they will have to pay back. They have to give to on lend to customers. So they cannot just on lend at exorbitant rates to customers. They'll come out of the business because no customer will go and lend from them. So that's why it does not apply to our financial institutions. Please, when you're writing, do well and say so. Do well and say so. So you can see here where a resident entity which is not a financial institution and in which 50% or more of the underlying ownership or control is held by an exempt person, either alone or together. So they can even combine to have that holding with an associate, has a debt to equity ratio in excess of what? 3:1 at any time during a basis period. A deduction is disallowed for any interest paid or foreign currency exchange loss incurred by that entity during that period, on that period, or during that period, on that part of the debt which exceeds the 3:1 ratio, being a portion of the interest or loss otherwise what? Deductible. So, very interesting. Okay, so that's all for the fin capitalization. But I would like to say this: there's something called back-to-back financing or back-to-back fin capitalization. People are bad. What this one means is that, you see, the resident entity knowing that the exempt person knowing that financial institutions who are resident entity are not included, what they do again is that if, for example, the exempt person owns a bank here, he can channel the loan through the bank to come and give it to that exempt control resident entity in Ghana, as if it is the bank that is giving the loan. Meanwhile, the loan is coming from that non-resident person, but it's doing so through a bank that it owns. So indirectly, it is the same non-resident person who is giving the bank to the exempt control resident entity, but it's only using the bank as a conduit to give the money to the exempt control resident entity. And that's what we mean by the back-to-back fin capitalization, back-to-back financing. Okay, so when that happens, and Commissioner General gets to know that the bank is only being used as a conduit, the principles regarding the tax avoidance, anti-avoidance provisions regarding fin capitalization will still apply to the resident entity, even though the resident entity might have taken the loan from the bank. After all, the money that the bank gave to the resident entity was not coming from the bank directly, but the bank is only being used as a channel. Okay, thank you. So don't say because they say it doesn't apply to financial institutions. So when you see a bank, don't know. Look at whether the bank, where did the bank get that facility before it's giving it to that resident entity. If it is coming from a parent company, that resident entity that is being controlled by that exempt person, please, the fin capitalization rule should still apply. Okay. The general anti-avoidance rule. You see, when we started, we said that the tax avoidance schemes are normally enacted to handle specific cases of tax avoidance. The anti-avoidance provisions were enacted in the law to handle specific cases of tax avoidance or general cases of what? Tax avoidance. This particular anti-avoidance rule was enacted to handle general cases of tax avoidance. In other words, where they cannot get an anti-avoidance rule to handle a specific case of tax avoidance, Commissioner General will fall on this general anti-avoidance rule. So what does this general anti-avoidance rule say? So it's very short. The Commissioner General may recharacterize or disregard an arrangement. Please, the word arrangement is very important. We come to see the definition right now. The Commissioner General, because when it comes to tax avoidance, be careful of the arrangement between the related parties. Okay, and you must always know what arrangement is. The Commissioner General may recharacterize or disregard an arrangement that is entered into or carried out as part of a tax avoidance scheme which is fictitious. In other words, the arrangement is what? Fictitious, artificial arrangement, a fictitious arrangement, an artificial arrangement. Once the Commissioner General knows that the whole arrangement between the related parties are artificial or fictitious, then the Commissioner General can what? Can recharacterize or disregard that arrangement. Or the arrangement does not have a substantial economic what? Effect. It doesn't even make an economic sense. Or the arrangement whose form does not reflect its substance. Look at the words they are using. Very nice words. Either the arrangement is artificial, either the arrangement is fictitious, or it does not have a substantial economic effect, or the form of the arrangement does not reflect the substance of the arrangement. In all these cases, the Commissioner has been empowered to recharacterize or disregard the whole arrangement and consider what the actual arrangement should have been. I repeat, and consider what the actual arrangement should have been. I'm coming to give you some example right now, and you see how arrangements can be very artificial or fictitious. The form which does not reflect the substance. But what's the meaning of an arrangement? In tax avoidance parlance. In tax avoidance parlance, or in related party situations, what do we mean by an arrangement? Okay, when they say an arrangement includes, in one CIT question, students were asked to explain what is an arrangement. And if you have not read, you sit down there, they'll come for your paper. Now, an arrangement includes, it can be an action, it can be an agreement. You see, so look at the one I was talking about. The guy, the non-resident, sent the money to the exempt controlled entity through a bank. So he's telling that, Charlie, don't worry, I will send the money to you through my bank, as if it is the bank that is giving you the money, and I will charge you that high interest. Because after all, the bank is not going to unlend that money to any customer, because that money came from me. It's an arrangement. You understand? So an arrangement is an action, an agreement, a course of conduct. It can even be a promise, a transaction, an understanding, or undertaking, which is expressed or implied, enforceable by legal proceedings or not, and unilateral, or involves two or more persons. That's the definition of an arrangement. Baba, this one, it don't mean definable. I didn't define it. So an arrangement includes what? An action, agreement, and the course of conduct, promise, transaction, undertaking, understanding, which is expressed or implied. It can be expressed, it can be implied, enforceable or not, and it involves two or more persons. One person cannot make an arrangement. Arrangement always involves what? Two or more persons. That's why once the people are related, it's very easy for them to engage in an arrangement. And tax avoidance includes an arrangement, the main purpose of which is to avoid or reduce tax liability. And tax avoidance, so when you are knocking it off, you knock it off with this one and say, and tax avoidance includes what? An arrangement. There's no tax avoidance where there's no arrangement. It includes what? An arrangement, the main purpose of which is to avoid or reduce what? Tax liability. I said I will give you some example here. The general anti-avoidance rule. It came in some the pilot question, the old ICA taxation syllabus, where they gave some pilot questions. Let me give you. Look at this arrangement. There was a parent company, or rather, there was a company. The company was into hotel, and they consume a lot of meat products. They consume a lot because the customers like it. They supply some to the restaurant and the hotel too. They've been using that for their guests. So seeing that they buy a lot of meat products, and they decided to set up a subsidiary that rears cattle. They decided to set up a subsidiary that rears what? Cattle. So they had a cattle farm being the subsidiary, so that the cattle farm will be supplying meat to the hotel. And the cattle farm was supplying the meat to the hotel at cutthroat prices, or what we say, exorbitant prices, supernormal prices. Why were they doing this? Look at the arrangement. Why were they carrying out this arrangement? The arrangement was to engage in tax avoidance, to avoid or reduce their tax liability. Now, note, by supplying the meat at exorbitant prices to the hotel, the revenue of the cattle farm will be so high, which will mean that their profit will be so high for that matter. Now, the purchase cost of the hotel will be so huge because of the price at which they are buying the meat from the subsidiary. And remember, hotel will be taxed at 22%. Okay, that's fine. So it means they'll be paying huge taxes because they'll be paying their profit become very small because the purchase cost of the meat is so huge. So that when they slap 22%, they'll pay lesser tax. But remember that the cattle farm will also be paying tax. But do you know, this arrangement only happened during the first 5 years of the cattle farm. What happens during the first 5 years of the cattle farm? The law says that under industry concessions, cattle farm is agriculture, and long term for that matter, they are taxed at 1% for the first 10 years, beginning from the date of first harvest. Which means that though they'll be making huge profit because they supply the meat to the hotel at exorbitant prices, the tax rate is only 1%. So just imagine. So this was the arrangement. This particular scheme of tax avoidance, there is no anti-avoidance provision in the law to handle that specific case. So in that case, the Commissioner General will fall on what? Will fall on the general anti-avoidance for today. So I'm done for the general anti-avoidance rule. So you see, so when that happens, you will see that the Commissioner General will see that this whole arrangement is artificial. It is fictitious. You see, it does not have a substantial economic effect. Why will you supply meat to your company at a price far above what the meat is being sold on the market? What is the economic sense in that? But you will realize that it's just an arrangement. You understand? So the law therefore says that once the Commissioner General is able to detect that the transaction is artificial or the whole arrangement is artificial and fictitious and does not have substantial economic effect or whose form does not reflect its substance, the Commissioner General may recharacterize or disregard that arrangement. So in this particular one, for example, after you have brought the principle, you tell the Commissioner General therefore will make sure that the cattle farm supplies the meat to the hotel at the market price, the price ruling on the market, at the arm's length price. Okay, so that the purchase cost will reflect the market price in the books of who? The hotel, and the revenue will also reflect the market price in the books of the cattle farm, so that they will all report on a fair profit for tax purposes. So we continue with taxation of shareholders. Okay. Now the law says that where the Commissioner General is satisfied that a company controlled by not more than 5 persons and their associates. So please, here when you are learning, it is a company controlled by who? Not more than what? 5 persons. So if the persons is 5 and below, then that is where this one will apply. So, but when the company is controlled by 6 persons and above, please, this particular tax avoidance scheme and its anti-avoidance provision doesn't apply here. So when you are learning, please, so if you have your book, you underline the word where the Commissioner General is satisfied that a company controlled by not more than 5 persons, so underline not more than 5 persons, and their associate does not distribute to its shareholders as dividends a reasonable part of the income of the company from all sources for a basis period within a reasonable time frame after the end of the basis period. Now, this is anti-avoidance provision. The Commissioner General may, by notice in writing, treat as dividend that part of the income of the company which the Commissioner General determines to be dividend paid to its shareholders during that period or any other period. So the point we are saying is that, you see, when it's a closed company, a company that is controlled by 5 persons or less, in Ghana, even 1 person can form a company now, you are aware. So if the company is controlled by 5 persons or less, you see, so if, for example, there are 2, one and the associate, it can be you and your wife, decide to form a company, or any other associate that you come together to form the company, okay, and the number is 5 or less. One of the things you can do is that even if we make huge profit, we can decide not to pay dividend to ourselves on grounds that on the presumption that we are applying back our profit into the business, because we know that when we pay dividend to ourselves, we'll be told to withhold a tax of what, 8%. Meanwhile, we have paid tax of 25% on the corporate income already, and then now when the income, the money, the part of the profit comes to us as dividend, then you tell us again to pay 8%. So please, we are not paying ourselves dividend. And if I have my company, if we have our company, and we say we are not paying ourselves dividend, what is illegal about it? There's nothing illegal about tax avoidance. You understand? That's why it is not punishable under the law. So, Commissioner General, knowing that it can happen this way, decided to enact the anti-avoidance provision in the law, which will compel the Commissioner General, by notice in writing, will write to the company and declare a reasonable part of the profit as dividend and ensure that they pay it to themselves so that he can get his withholding tax on the dividend. That's about the taxation of shareholders. However, please add this: the Commissioner General shall, in determining whether a company has distributed a reasonable part of its income from all sources for a basis period, consider, what they are saying is that where the Commissioner General want to declare some reasonable part of their income as dividend to them, in his decision whether to declare or not, he should consider the current requirement of the business of the company after accounting for any adjustment with the Commissioner General, which the Commissioner General may make. That is the arm's length standard and arrangement between associates. Okay, if there is any unrelated thing after doing that, the Commissioner General should consider whether all the arm's length arrangements have been done and any other requirement that is necessary for the maintenance and development of the business. Perhaps it is true that they need to grow the business, so they don't want to declare the profits now so as to plow it back for investment to grow the business. So in trying to decide whether to declare a reasonable part of the profit as dividend to the shareholders, please, you should also look at the requirement necessary for the maintenance and development of the business. If genuinely they really need to plow back the profit for maintenance and development of the business, then he will back off from declaring that reasonable part of their income as dividend. So it is not in all cases that when the persons are 5 or less and they refuse to declare a reasonable part of their income as dividend, Commissioner General will by force do that. No. The law requires the Commissioner General to also look at the current requirement of the business and any other requirements that are necessary for the maintenance and development of the business before taking such a decision.